Are we in growth mode or are we in income mode? If we're in growth mode, it means we have some form of earned income, most likely, or passive income, but we need to build up a larger nest egg for later so we don't ever have to worry about anything. So if we're in growth mode, we're operating under one philosophy.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today's guest is James Alexander. He's a certified financial planner and partner at Edge Financial Advisors. With over a decade of experience, James specializes in guiding families and business owners toward financial peace by blending practical strategies with the psychology of money. Known for his relatable advice and creative financial solutions, James is passionate about helping people play their own financial game and make confident, informed decisions about their future. James, excited to have you with us today. How are you?
I am doing great. Thanks so much for having me on.
Absolutely. So let's dive right into it. Clint mentioned at the intro, which is, can you break down what you mean by the concept of playing your own financial game? And how does that apply to someone just starting to think about passive investments?
Absolutely. It's one of my most passionate topics. So in my world, playing your own financial game is not listening to others who are in a different stage of life, to have different goals than you do. And I have seen this quite a bit, where we're listening to the news and there's stock tips and there's, real estate endeavors, and we get distracted by all this noise without actually understanding what are we trying to get out of our life and how do financial assets fit in there. And how do I earmark my assets towards what I want? And, it's one of those things that you've heard, keeping up with the Joneses. It's a common phrase, but think about your neighbor that brags about the next, cryptocurrency he found. What is he trying to do with that money? What are you trying to do with that money? Most of these arguments I've seen people have is people playing different games, just talking over each other. That's it.
I find this, this is coming at a really interesting time. Like the world is so full of distractions right now, right? Shiny object syndrome is everywhere. We have more opportunity in a good way, like opportunity to different investment strategies than we've ever had before. But we also have more opportunity in a bad way, in that it's in our face. It's in our social media feeds. Everybody's talking about it. It's all over the news. Crypto is everywhere. You got the Doge bros from the election that just happened that are coming down the pipeline in January. And you've got this scarcity. People are scared not to invest in Bitcoin. Like I saw yesterday, Bitcoin's at $96,000, just down from 100. And you got people pouring in afraid of getting left out. It's like, the real question is that the game that you're playing, or that's the game that everybody else is playing? And so now you feel like you've got to play it. So you bring up a really interesting point. I know from the conversation we started having before we hit record and came on here, you're a very well-rounded financial planner. There's a lot going on in terms of the conversation we had, the different offerings, playing offense, playing defense, the tax benefits. Tell us a little bit about how you got to where you are, how you started, and how did you become so well-rounded in everything that you're willing and able to offer your clients?
Sure. No, appreciate the question. It's been a learning experience for me, I fully admit. My original intent, so I've been in Chicago my entire life, Chicagoland. So I'm not very nomadic. My wife is the exact opposite. I went to Loyola University in downtown Chicago, and my intent was to teach math. I wanted to be a math professor. And so I majored in math. And I quickly realized if I didn't enjoy teaching that, there's not a lot of fallback options. And so I ended up going down the business route and absolutely fell in love with finance. It's money with numbers, right? At the end of the day. Because a lot of people told me, you need to be an actuary. For those that know actuaries, I just don't have the personality for that. I love numbers. I also enjoy helping and talking with other people. And so when I graduated in the housing market crisis. Fun time to graduate. That was one of the best blessings for me looking back, is I worked at a company called Scottrade Investments. Many of you listening that know Scottrade, we had the helicopter commercials advertising the $7 trades. A lot of that was good because it was open architecture, to your point, and we have so many more opportunities than we've ever had before. Our parents had pensions and they didn't really worry about retirement. Here it's us. We can retire when we want, but we got to figure it out on ourselves, right? Well, so that's where the Scottrades and the TD Waterhouses that became Ameritrade and Schwab's took over. And so I bring all this up because when I was at Scottrade, I had experienced people with massive amounts of wealth get too greedy or too fearful and lose it all. And I saw it firsthand. I saw us getting into Fannie Mae and Freddie Mac, people pouring hundreds of thousands of dollars thinking it's going to rebound. Lehman Brothers. I mean, all these disaster. We could spend a whole podcast talking about ways to make mistakes that way. But as I learned along the way, I thought, why are these people doing it? They're so good at their profession. They've earned significant seven-figure wealth and they've lost it all. And a lot of that has to do with the distractions in our world, the fear of missing out, all these psychology components that I wanted to lean into as I developed my career, because I vowed to myself, the clients that work with me, certainly I want to help them build their wealth over time. But I also need to help them be at peace with this and avoid these financial mistakes, because to your point, these distractions are only going to accelerate. These retail stores know the game they play with free credit card interest for 6 months. All these components, they are playing that game to distract you and get you off your path to financial success. So long-winded answer to your short question, but that's how I got to be where I am today.
So how do you sorry, fumbling my words here, but with all these distractions, you talk about bucketing your investments. And we were talking, beforehand about short-term, medium-term, long-term. Is it beyond that? Can you explain that concept?
You bet. I'll even take it a slight step back. And part of my job as a financial advisor is to make the complex simple. And so let's simplify everything right now. Are we in growth mode or are we in income mode? If we're in growth mode, it means we have some form of earned income, most likely, or passive income, but we need to build up a larger nest egg for later so we don't ever have to worry about anything. So if we're in growth mode, we're operating under one philosophy. It's like playing football. And then we shift over to income mode. We're still playing a sport. We're investing and we're all that, but now we're playing baseball. And so it's a different type of sport we're playing. And so how does that tie into buckets? Well, growth mode, you are socking away as much as you can. Make sure you have enough reserves. It's somewhat simple. I mean, not incredibly, but income mode is a very, very different can of worms. When you're in income mode, you want to make sure that you can live the life you want to live and never have to worry about running out of money. And that is the big unknown for everybody. And so I want to bucket my money into what we help people with is the first 5 to 7 years of my income needs. We figure it all out, write it all down. We need to make sure we have enough in there earning some money. We're not earning nothing, but safer type investments in the first 5 to 7 years of my next life, the next 5 to 7 years of my life. Then in the intermediate term, that's typically 7 to 12 to 15 years. It all depends on personal preference and some capacities, but 7 to 15 years, intermediate term, and then 15 years plus is long term. And so those strategies in each bucket should be very different. I should be, the cryptocurrency, if I love that, is in my 15 plus year bucket. Versus, even some money markets, bonds, things of that nature, real estate that's spitting out income, just that income piece is going into my short term because I know I'm getting it. And so if I think about bucketing it out my money, what that does is first, it's clear to me when I do it that way. And second, when the markets get rocky, which if you're young listening to this, they will get rocky 5 to 7 more times in your life. That's a fact. What are you going to do when that time comes? If all my money's in aggressive, I'm going to be anxious. And so I need to make sure I understand this money's for the first 5 years, this money's for the next 10, this money's thereafter. I can balance that out accordingly. And no, I'm not touching this 15-year money despite it down 30% right now. And so it provides that clarity for people when you bucket it out.
I love that. I'm curious how you would take this concept to someone who is primarily invested in private placements like real estate syndications and things like that, where it can be a strict growth play where you're investing in some project that it isn't paying any income, and you're just hoping it's going to double your money in the next 5 years. But there's a lot of syndications out there that do have an income component, a preferred return that's paying out, but on top of that, it's got a growth component. I'm just curious how you would define that and how you would conceptualize that.
Yeah, no, great question. I would attribute it all to the risk of that money coming back. The probability of me getting that money. As an example, in that private placement, that income, if I feel very confident that income will be coming, I can put that in the shorter term if I know it's spitting out every year. But that growth component, we don't know what that value is going to be. We want it to be as high as possible. That growth component should at least be in our middle bucket, if not in the longer term bucket, depending on the risk of the project. And so you can take each individual asset class, for example, dividend paying stocks, right? The dividend might be in my short term because, it's paid, but we don't know what the value is going to be down the road. And so that's where you can split it up and you got to run some spreadsheets. You got to make sure you understand your numbers. But when you look at it that way, I can't tell you how many clients, they just have clarity. They say, okay, I have 5 years of income needs met. So then I can take more risk and not feel anxious about it with everything else on this side. So yeah, it can apply to a lot of different investments, but that's one that can get a little tricky, and there's some subjectivity there too. So that's where psychology comes into play as a final note of, what keeps you up at night? We talk about debt. Some people are so comfortable with debt, and other people, even though the math checks out, I get a 3% mortgage and I can earn it invested elsewhere. I hate owing anybody anything, right? So we talk through that. So anyways, yeah, good point.
I love the idea of having the different buckets, but tied to specific timelines. It helps put some more clarity on that. Like, no, this is short term, but like, I've never asked myself that. Like, what does short term mean? If short term means 5 to 7 years, it's different than 1 to 3 years, right? Like, if that's your 5 to 7, that's your short term, your mid term, your long term buckets. It's really good to kind of in your mind be able to compartmentalize that money and just turn off the worry about that. That's not today's problem. That's 15 years from now's problem, right? We're going to let that sit and cook and do what it's going to do. Let me ask you this, James. I'm 42 years old. I got 2 young boys. And right now we're building up assets as general partners. A lot of what we get out of the deals that we do, the investors get paid first, assets protected first, then the investors are paid, and then we get paid on the back end. So a lot of what we're doing is like long-term gains and eventually filling up that middle and long-term bucket. But as a young guy that's youngish, not young guy focused on that income bucket, is there anything, you mentioned some of the products before that you really like some of the really unique things that you think address the income bucket in a unique way based upon the challenges that we have in the current day and age right now?
Yeah, no. So interest rates are higher than they have been in the last 15 years, but signs are pointing to that not continuing. And so how do we get yield safely in that short-term bucket is what I'm hearing you ask for someone like yourself, which I thought the same for me too. And so there's one specific investment product. While I'd be the first to say we don't make commissions on any investments that we offer people, there is one investment product that we found to be very attractive in the short-term bucket based on essentially an arbitrage for those that are familiar with that concept. It's called an income structured note. What in the world is an income structured note? Well, here's how it works is banks issue these out to institutions or to individual people. They are geared for one purpose only, which is the most simple purpose, paying you a stream of income. That's it. Think of it like a bond where you give a bunch of money and then you get a stream of income paid out, say quarterly, until the bond is done, and then you get your money back. And what's the risk of you not getting your money back if the bond is, still existing at that time and can pay all their debts? Think about that concept and amplify it a little bit. So an income structured note, instead of paying 4, 5, 6%, it pays 9, 10, 11% per year. And what happens is the risk of you not getting your money back is the risk of the markets, namely the stock markets, being down significantly over the period of time that you hold that investment. I'll give you an example. I provide a $50,000 investment into an income note that matures in 5 years. So that's my 5-year bucket. I got an income stream, and then I get my money back, and then I can roll it after that. So if I'm getting a 10% rate of return on that, that's $5,000 a year, each and every year for 5 years, and then $50,000 back at the end. When would I not get my $50,000 back? Is if the principal is tied to, say, the S&P 500, most of us know that, and say the Dow Jones. If either of those indexes over that entire 5-year period of time are down more than, say, 30% total, then I have risk of losing my principal. Not all of it, but I have risk of losing some of my principal on the back end. So that's the principal risk I have. Instead of a bankruptcy for a corporate bond, this is a volatile stock market. And what we do as advisors, we stress test all this risk. What's the probability of the stock market being down 30%, not in 1 year, that's happened plenty, over a total 5-year period of time? And so for those comfortable with something like that, it pays. Right now, we're seeing them pay double-digit % return. And that's pretty attractive for a lot of people that are searching for yield. Now, those listening may hear, okay, that seems too high. What's the catch? There's one big component to this that is low probability, high consequence. And that is these banks issue them out. So you become a lender to the bank that issues them out. Now, JP Morgan, Bank of America, those type of banks are the ones we purchase them from. But if that bank were to ever go bankrupt, you're a lender, you're a bondholder to them. You may not get all of your money back. In fact, odds are you won't. And so what we do is we diversify amongst banks for people and spread it all out. So that's it in a nutshell, but that investment part really works well in the short term.
So does that mean that the banks paying the higher returns are usually affiliated with a little bit higher risk? Are you going to get an 8% return from Bank of America and you might get 10 from somebody else, or how does that work?
A great question. No, in fact, no. That's one would think that logically. How do they get those rates of return? I'm going to do my best to simplify this, but it depends on the VIX, which is the volatility of the stock market. That's where options are priced, along with the interest rate environment. And so in a nutshell, when the volatility is high and interest rates are high, these things become more and more attractive. And the way the banks construct these, to take one step back further, is I buy a zero coupon bond, which is a bond that doesn't pay any interest. Instead, I might pay 80 cents on the dollar today, and in 3 years, I get my dollar back. I buy a zero coupon bond at 80 cents on the dollar. That gives me 20 cents to create a whole bunch of options to create this income stream. And so it's less about the individual bank and it's more about the market environment that creates these notes. But the worst we've seen is 7% to 8%. I mean, it's still better than money markets, of course, with that risk.
And how is the average investor using this? How is your average client using this in their portfolio?
It's part of the broader scope of a portfolio for them. So we have carved out for people that want these investments, 20 to 25% of their portfolios in them. And then about, depending on their risk tolerance, they have bonds and stocks and everywhere in between within the rest of the mix. And so if there wasn't that bank risk and there wasn't liquidity needs, we'd have a lot more money in these for them. But because of the bank risk, the last thing you want to have happen is these things banks to go under. Now, the odds of banks going under, I think we'd have other issues if most of these banks went under, but it's not impossible.
Yeah, we've seen a little bit of risk of that. In fact, in the last year or two, we had Bank OZK, which we just signed a refinance with them, and next thing you know, they popped up on a list and we're like, oh, that would have been good to have 3 weeks ago. But there is some risk, there's some volatility. We saw one or two I think Silicon Valley, went down and there's a reallocation there. We didn't see the giant house of cards fall that everybody was worried about, but there is some risk there. In terms of the risk of the entire market being down for 5 years at a time, how often have we seen that?
Yeah, 2 times has it happened, and you'd have to time it perfectly. This was going way back to 1924, starting all the way to 1929, which was middle of the Great Depression, when you look at that 5-year period of time. And then you'd have to time it within the perfect months of our recent scenario, but 2005-ish to 2010, when that market, even the tech bubble in 2001, when that happened, didn't happen. So in short, there's a 98.5% chance this won't happen. Not 0, not 100, but I like those odds.
This is one of those products that, to me, makes sense when it's coming from a fiduciary that's on a payment system versus somebody that's coming on commission. You know what I mean? Like, anytime you hear about something it's an alternative strategy, and don't get me wrong, we operate in the alternative investment space, but this is like, it's a paper asset, but it's an alternative to anything. I haven't heard about this before. You're the first person to bring this up on a podcast in 80 something episodes. So anytime you hear about that, it can kind of create some red flags to go off in your head. And that's what I love. Like, the relationship that a lot of people have established these days with a fiduciary who you're paying them the same no matter what their performance is, and he's not getting commissions or churning and trying to roll you into multiple things. I think it makes a lot more sense in that situation. Let me ask you this. This is kind of going in a different direction. One of the things we're starting to hear about a lot these days is an RIA, a registered investment advisor. We don't know that much about it, but I know that that's people that are starting to realize more people are looking at different alternative investment strategies, and it kind of opens those people up to be able to talk about real estate. What are some of the different structures we see these days for financial planners? Like, you're taking a flat fee. You're basically a fiduciary, but it feels like that landscape is changing a little bit right now. What are we kind of seeing out there, and what do you recommend people look for when they're looking for a financial planner to help them with their midterm, long-term, short-term goals? That's if you're a little bit off, that makes a big difference over a 15-year time period. So what are some of the things you recommend people look for?
Absolutely. Yeah. RIA, I'll expand that even further to say independent RIA is what I believe. Now, I'm biased, obviously, because we are one, but independent RIA is what most people should be looking for at this stage of the game. Everyone has their place for different purposes. A registered investment advisor, what that means in short is, and fiduciary registered investment advisor is, we are problem solvers. And people pay us money out of their pocket. They see it to solve their problems financially. Instead of, when I talk to people that work at other wirehouses, and I don't want to name any names on this episode, but other companies, and they say, I'm not paying them a fee. Well, nobody works for free. And so where are they getting their money from? It's most likely the investments that they're recommending. And then you have to ask yourself, is that in the best interest of myself? And so our job, speaking of these structured notes, in fact, it's more work for us, for people to have these. And we don't make anything more on that, but it's right for the right people. And so that's the lens that we operate on. What should people be looking for? Going back to your question, they should be looking for someone, first off, that has enough to equip knowledge around the whole financial marketplace. Not just stocks and bonds, which is what every advisor is going to talk to you about. Those are the foundations. But alternative investments are very important, and they'll become more and more popular as we progress in this society the way we're going. But also tax, right? You talk to your investment guy, they recommend certain investments, and then all of a sudden you go to your accountant, and now I'm getting a massive tax bill I didn't plan for. That's a problem. And then insurance, all these things tie together. And so certified financial planner is something that I would highly encourage those that are looking for someone to make sure they have that qualification. That's important.
Let's you've opened Pandora's box a little bit with the tax discussion. Why don't tell us about some of the things? So our listeners are a background of a lot of white coat professionals. We have a lot of W-2 earners. We also have some 1099, small tech people, West Coast, that have started reaching out to us a lot more recently. But a lot of of W-2 earners, high income earning individuals and things like that. Everybody's always focused on the offensive side, right? How do I put my money to work and how do I put it out there and make it earn a return? Not understanding that you have a partner in every investment that you make, and it's Uncle Sam, right? So what are some of the things that people should keep in mind that could have a big effect on them in the long term, especially when you're zooming out 10 years?
Yeah. So I'll talk about two things briefly. One is every single asset that we own can be categorized in one of three buckets. Going back to buckets, these are different buckets now. After-tax money that is invested that I pay capital gains on if I hold it more than a year. That's one bucket. Second bucket is tax-deferred money, which is money that I get a write-off by putting in, and then it grows without any taxes every single year until I pull out, and then I'm taxed on all of it. And then the third bucket is a tax-free bucket, which is what we love, right? And that's, I don't get a write-off for putting that money in, but it grows tax-free and then tax-free on the way out. So those are the three buckets. So keeping that in mind, when you are in your high income years, high income meaning I'm in higher tax brackets, and while we do think taxes will stay low for the next 4 years, we have a debt from the country that the bill is coming due very soon, and the only way around that from a pure mathematical standpoint is to tax somebody more. That's, unless we don't want to invest in our country, and I don't think that's something people want to do. And so odds are taxes will go up most likely in the next 5 to 10 years, and it could go up substantially. And so if we are in high income earning years and we expect that to be the case for the next 10 years for ourselves, a tax savings vehicle, another one we've found, it's in the IRS code, is through investing in something similar to a 401k. But instead of that, it's called a defined benefit plan. Defined benefit plan is basically your old school pension plans that you as the owner wear all the cards. You have all the control over. And so in a nutshell, how it works is I'm 55 years old. I pick a retirement date at 62. I have 7 years to get there. At 62, I pick a pot of money I want to have, 2.5 million, let's say. I'm picking a large number by design. I have 7 years from 55 to 62 to get to $2.5 million. And I'm starting from zero in this plan. Now so year one, I might need to put in $250,000 a year, every single year, to get to that 2.5 million when you adjust for growth. Well, if you have enough income, you create the structure that you want and you put $250,000 in there. What's the benefit of doing that? You receive a $250,000 tax write-off on your taxes that year that you have high income. And so 401ks, people are saying, I could cap out at 70 grand and that's it. That's all I can do. What else is there? This is an idea.
So you create your own pension fund and you get dollar for dollar write-off for every dollar that you put in. And then when you hit the maturity date of that and it starts paying out to you, you're paying taxes then, I'm assuming. Right?
That's right.
Yeah,
yep.
But it's deferred and it grew tax-free up until then, and you take that write-off 7 or 10 years earlier.
Exactly right. Time value money is important. So you get a massive write-off, you create your own pension, you get time value money. The other more important argument is we have conversations with people about this. If I'm making $500,000 a year right now, and I know that won't continue to be the case over the rest of my life, do it now while your tax rates are higher. Even if they go up later, you don't have any more earned income when you're retired. So the tax game changes. I can take capital gains from my taxable bucket, pay 15% on that, only on the gain. So I might live on $200,000 a year, but the IRS is seeing me as having 60 grand of gains. And then I can take my distributions from my IRA and or convert them to Roth. And now I'm opening up another can of worms. But the idea being is if I think my taxes are going to be lower later, and I'm getting crushed now, seriously look at it.
Are you forced to start taking money out of that pension once you hit retirement age?
You are forced to at 73. It's the new RMD rules, so there's time.
Interesting. That's another vehicle I've heard. See, this is why we do this.
Correct. Correct.
The people think that we do a podcast because, we're trying to educate people, but really, we just get in here and get to ask all these selfish questions, and you can't go anywhere for 30, 45 minutes. We got you pinned down, so. That's two. That's
and Clint, we get to spread that knowledge.
I mean, we care about our listener base. No, we do, but that's why I love this. Like it becomes a lightning rod for better conversations. We've heard about two talking points right here, one offensive and one defensive, that over a period of years have potential to swing people's net worth for their families by a tremendous amount, right? And I used to think about money as like, yeah, money's really important because it's going to allow me to buy all of these things or to have these experiences. And that's still true. But the reality is for me, I've just come to the point, and I've said this a lot on this podcast, is like, I don't really care about dying with a bunch of toys. I care about dying with a stack of pictures of cool things I did, beautiful places with people that I love, and which for me is my family and my sons, right? And the money no longer, and Neil apparently, for those watching the YouTube, it gets to the point that the money is a representation of time that I can spend with my family when I'm not trading it to somebody else, right? I'm not trading my time for money. It's a reflection of the amount of time that I get to spend with my family and trying to build character in them that hopefully affects the amount of time that they want to spend with their kids and their grandkids and what a normal relationship looks like. It's in that context with young boys, it means so much more than just money, right? It's just money. Neil likes to call it, your money is a store of your life energy, right? It's a representation of time that you spent away from the people that you love doing something you probably didn't want to do because you traded that time for that money. And it's our responsibility to take care of that money, because otherwise it's frivolous for you to have spent your time in your life doing that if you're not going to, show honor to that by trading your time for that money to do something with it that's going to affect your family in the long run. And so we always talk about the offensive strategies that we have, but the big point is, look, there's a huge chunk of it you're going to give to the government anyway. So if we can avoid that, it just makes all that time so much worthwhile. So I appreciate your willingness to share that. I mean, what else are some of the challenges that you think people, let me take a step back and say this. I often say that I kind of feel like my generation has lost our ability to save our way to retirement. I feel like a lot of my, I had a 16-year career in the medical industry. So because of that, most of the people I'm surrounded with are very high earning income individuals that went to med school and then college and then med school and then residency and then fellowship and then surgical fellowship. And, you start to compare yourself with the people that you're friends with. And I'm like, there's no way that I can ever get there compared to what these people are doing. But the funny thing is, even the people in the white coat profession, most of them lose their ability to save their way to retirement because they start spending, they go from making no money to now they're making really good money. And then they get the cars and then they get the house and then they make partner and then they get the bigger house. And then it starts with the private schools and everything else. And next thing you know, they're 5, 7, 8 years in and they realize I can never retire unless I change the way that I, spend my money. And they're not willing to do that because it's a lifestyle choice. So in the event that it's true that our generation potentially has lost our ability to save our way to retirement because we don't have the Social Security pensions and 401ks, what do you think someone right now in their 30s, 40s needs to do to put themselves in a position where they're not going to spend, their last days on earth trying to get up and go to work for their family?
This is such a passionate topic I have. I'm so glad you brought it up. So to answer your question directly, the short answer, I'm going to expand upon it, is what should they be doing? They should be educating themselves. You spend 75% of your time at work in some capacity in the field that they're doing. Take 5% of that and educate yourself about how this money game works. And I'm not talking about, taking classes and going to an institution. I'm talking, it's out there. And it was some of the education that they may realize is the power of time. When you're 40 years old, you still have a lot of time. You run some numbers, right? I'm the big nerdy math guy. You run some numbers on this stuff when you incorporate taxes and investment returns and all that. You'd see how a little bit can go a long way when you have time on your side. But, taking even one step back further is what I'm hearing people when they get in that rat race, right? Talking about playing another person's game by wanting to have them fancy everything because I deserve it because I work so hard. You're actually canceling out your hard work without realizing it. And so, what happens then is you are saying, okay, I deserve everything. I don't need to worry about the future. I'll just keep on this hamster on a wheel mindset. And I don't actually have a destination of what I'm actually trying to accomplish in my life. I'm not writing down what's important to me. And so, you don't have a GPS system driving to your game. And that's a mindset shift that people have to have, because part of that psychology that I'm passionate about is I can run numbers all day long. You have to be motivated to want to do it. And there's two pains in this world. I've learned from people who in their 80s right now that I talk to, and people in their 40s that I talk to. So please don't shoot the messenger when I say this. There are two pains in this world: the pain of sacrifice early on. And I'm not talking about, working 80 hours a week and socking away everything. I mean, you'd be surprised at what little sacrifice there is when you do over a long period of time. But pain of sacrifice, or the pain of regret. And the pain of regret I've experienced firsthand with people in their 70s and 80s that are penny pinching because they never figured out this financial game. When you're 80, do you want to look at your 40-year-old self? How happy do you want to be with that 40-year-old self? It's a difficult thing to process, but hopefully has you all listening to think about some areas of your life and what you want to accomplish, what's important to you.
Well, I think that's a great place to end it. That was really very powerful. James Alexander, thank you so much for educating Clint and I and our audience here today. If any of our listeners want to reach out to you and find out more about what you're all about, what would be the best way for them to do that?
Sure thing. No, been an absolute pleasure to be on. Our website is Edge, F as in Frank, A as in Apple.com. I'm right there on the first page. And for those that were interested in that defined benefit plan I talked about, that tax saving strategy, we have a separate website for that. It's yourretirementaccelerator.com.
Awesome. Well, James, thank you so much. I certainly enjoyed it. I just want to say thanks again for taking the time. I really appreciate it. And thanks for stepping up and being willing to educate our listener base. So appreciate you coming on.
Pleasure. Thanks again.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.